Hey there, everyone. Welcome back to another episode of the Female Empowered Podcast. I'm your host, Christa Gurka, and we have a guest episode today for our financial month. So February was all marketing, and then March, we're going to talk about finances. And who better to lead it off than the founder and CEO of Kickstart Accounting Inc., who happens to be our money team in our Inner Circle, Beyond the Movement Inner Circle program, Danielle Hayden. We have her here. So Danielle, for those of you that are for my audience that has not heard of you before, will you give yourself a little intro as to who you are and what it is that you do?
Yeah. Danielle Hayden with Kickstart Accounting Inc. We are celebrating our 10-year anniversary this month, which is crazy. We help business owners understand their numbers to make better business decisions. We use bookkeeping as a vehicle to keep them organized. And, numbers are about so much more than arriving at tax season. It's more than just having the right tax write-offs and saving the most on taxes. It's really about becoming a more holistic business owner where you actually know your numbers. You are making business decisions that align with your goals throughout the year. You have the information that you need. And the benefit is that you can arrive at tax time really confident and empowered and in control. So we do bookkeeping, CFO, and tax work for all of our amazing clients. And I'm feeling especially grateful right now. I am in awe of how many business owners we get to help and the amazing impact that they're making in their communities because they know their numbers.
Yeah, it's so great. It's so, so great. And I think I'm sure you hear it a lot because we talk about it in the groups where people are just like, I'm not a numbers person. I'm scared of my numbers. I'm afraid of what they're going to tell me. And the point for myself, at least when I help other women understand what their numbers mean, and I heard it from you too, is there's no judgment around the numbers. It just, this is what the numbers are telling us, and we can learn it. You're not going to become a numbers specialist in a month, but it's like over a 10-year period, right, of just being a business owner, you've learned a tremendous amount in 10 years, right? And it's so like it's just taking one step at a time. Would you agree?
The numbers can become a toolbox or a tool in our toolbox. You know, I didn't get it 10 years ago. I thought numbers were just numbers. And I was working as a CFO. So to me, I was working with these private equity groups and investors and these high level CEOs that they took the information, they made decisions. Well, in entrepreneurship, we have so many emotions tied to our money, tied to our business, tied to the decisions that we're making. And I think there's a little bit of a report card effect where every quarter we get our financials and we're like, oh, is mom going to ground me? Are they going to tell me I failed? Am I still talking too much? I'm not good enough to do this thing. And so if we can start to change our mindset from, oh my God, if I open this email from my bookkeeper and it tells me I'm not profitable this month, like if we can go from I'm broken, I don't belong, I'm not able to do this to, oh, interesting. Okay, so that's how that all landed. Let me look at this and understand what worked and what didn't work so that I can do things differently. Maybe taking a loss was what you needed that month, right? Like if I can just start
Right.
thinking of it as like a growth opportunity.
Right, for sure. And I think having you in our mentorship groups and available to business owners who have these questions that, again, to get on a call with my accountant is going to cost me $300 an hour to answer a question where it's like, here, this is how it works in the real world, and this is what it means for you and your business. So I thought what would be good today was basically to do kind of like a rapid fire Q&A. I pulled the most common questions we've gotten in our mentorship groups over the last like 2 or 3 calls, and I'm putting them together because, like, right, if one person has a question, more people probably have that question. And I feel like these questions are the ones we get over and over. So you cool with that?
Absolutely. Let's do it. I'm here for it.
Okay. So the first question actually is not necessarily something that people ask all the time, but I know it's what they're feeling. If someone is just starting in their business, or maybe they're in their business for a while, but they're really saying, I'm going to take control and start somewhere with my numbers, what is advice that you would give them? How should they start? Is there one specific thing they should do first?
Well, can I take this like all the way to a beginner? It's
Totally,
like
totally.
start all the way at the beginning. So and it doesn't mean, when I say beginning, it doesn't mean necessarily like the beginning of business, because I've worked with business owners who are 10 years in business, and we still need to
Mhm.
start at the fundamentals. So this is for anybody. The first things first is keeping our business and personal accounts 100% separate.
Yeah.
From a legal perspective, every time you commingle business and personal, you are piercing the corporate veil. And the IRS, you are opening the IRS up to an audit when you are commingling your business and personal. You need to have a business checking account where the only thing that goes to that account is your business activity. And I would go into more detail, but I really think fundamentally people understand that. You just don't want to.
Mhm.
If I'm going to
Mhm.
pay for my kids' daycare, that needs to come out of my personal account. If I'm paying
Mhm.
my mortgage for my home, that comes out of my personal account. If I am paying my contractor or putting a down payment on a new building, right? Like that has to come from my business account. So first things first is keeping that 100% separate. It's going to help your bookkeeping team or your tax team be able to have accurate numbers that you can look at in the first place.
Yeah, totally agree. Everything should be like business and personal should be separate. So, okay. So the next biggest question I feel that we get is understanding S-Corp status in terms of filing for your taxes. So can you explain the difference between LLC or sole proprietorship and an S-Corp status? So can you start with just what are the two differences from an IRS perspective?
So most people, when they start their business, they start as a sole proprietor or an LLC. And that is correct. When you do that, business and personal still separate. When you pay yourself, you are paying yourself as an owner's draw and not through payroll. As an LLC, you have to pay yourself through owner's draws, meaning you are not a business expense to your business. You are going up to the cash ATM of your business. So you are just a cash transaction. So when you look at your profit and loss statement, because after you've separated your business and personal, you have to have an accounting software. We use QuickBooks Online for most of our clients. It's still a very superior product to most of the cheaper versions out there. You have to have an accounting software. And when you pull your profit and loss statement, you do not want any owner's draws on your income statement. If you're doing your own bookkeeping, I have seen this happen. As an LLC, you are not a business expense to your business. You are taking what's equity out of your business. When you become an S-Corp, you are telling the government, you're telling the IRS that I am now going to be on payroll. I'm now a business expense. You can still take owner's draws once you've paid yourself a reasonable compensation. The reason why people do an S Corp is because it is more tax advantageous for business owners. It can be more tax advantageous for business owners, not always. I don't want anyone to consider becoming an S Corp until you've hit three things. We've increased this recently. We used to say 75,000 a year in net income. We really want you closer to 100,000. So about $100,000 a year in net income for 2 years. So not an anomaly, not 1 year. It has to be
Mhm.
2 years. That makes sense?
So can I just ask a clarifying
Yeah,
question
go,
on
go,
that?
yeah, yeah.
So the net income just is the income we have left after paying all of our expenses. So does that net income, when you're deciding if you're going to become an LLC, an S Corp, include like before you've paid yourself out of distributions, or it's all of your net income? Did I say that the right way?
It's coming from your net income. So you run your profit and loss statement,
Mhm.
and it's not your revenue at the top. It's
Yep.
after your cost of goods sold, after all your operating expenses, it's that amount at the very bottom of the profit and loss. Your owner's
Right.
draws are on the balance sheet. So when you are talking about net income, your owner's draws has nothing to
Okay.
do with the calculation.
Got it. So you're just saying net income, purely net income. Okay. And it's not including, like, what I was thinking is if somebody would say your net income is 100,000, like your net income is really $150,000, but you took $50,000 in distribution. So at least you're left with $100,000, even though I know that's technically not your net income.
Correct.
Right. And so you're saying for 2 years. And
Two
is the
years.
reason, I'm just going into assumptions now, is the reason $100,000 is because if you become an S Corp before that, you may not actually be able to pay yourself anything?
So you got it. So point number 2 on this is that you have to be regularly taking owner's draws today. So just like we can't go on a diet on Monday and we're going to suddenly stick to it and we're going to be a marathon runner, you're also not going to suddenly start paying yourself just because you become an S Corp, you go on payroll. As an S Corp, you have to pay yourself a reasonable compensation. And we'll get into that a little bit further. You have to be able to pay yourself through payroll. And so I want you to be comfortable and used to the fact that there's cash coming out of your business. I can't tell you the number of horror stories we've had over the years where somebody has a really good year and we're so excited, right? They're excited. We're so excited for them. They become an S Corp. And then something happens either in
Mhm.
their personal life, in the business, somebody leaves, right? Like something changes and they're an S Corp. They have to pay themselves a reasonable compensation, but they can't. And so what happens is the client will say to us, I need $5,000 for my personal bills. I have to have $5,000 this month. We're like, well, it needs to go through payroll. And they'll say, no, I can't pay the payroll tax. I have to have all $5,000. I only have $5,000 in cash. I need it all. Well, the IRS doesn't want you to um, actually lose money because you're paying yourself, but you cannot take any draws, taxes paid, or personal expenses until you've paid yourself that reasonable compensation. And it becomes really difficult if we have those fluctuations in our business. So we want to have 2 years to ensure that we have enough profit. And then we want to be paying ourselves on a regular basis so that we know the business has the cash.
Makes sense. Okay. So now I'm thinking if I'm a newer business owner, I'm still an LLC or a sole proprietorship, right? What are the benefits to me to becoming an S Corp? Why would I just not just stay this way and keep taking owner's draws?
Um, it becomes tax advantageous to become an S Corp. So you can put yourself on payroll, you're paying into payroll tax, you're also paying into the payroll taxes.
Mhm.
You can then have a paycheck from your business. So it's really nice when I go buy a car or a home. I don't even tell them I'm self-employed. I'm not. I'm employed by Kickstart, and Kickstart Accounting gives me a paycheck stub, and so I literally just give them my paycheck stub. So I don't have issues around personally getting funding for vehicles or a home loan. So I am establishing credit for myself as an individual and not just as a self-employed business owner.
Perfect. That makes total sense. I do want to just make a clarification because I think some people get confused by this. So there also is a way that you're, so for Pilates and the Grove, for example, I'm a single member LLC. However, I file my taxes as an S Corp. And so I think some people get confused that they could be an LLC by legal definition, but they file their taxes as an S Corp, not as an LLC. And there's that question on the W-9 when you fill it out that
Yep.
says, and people get confused. So that's correct? So you, by a legal definition, you can be incorporated as an LLC, but you file your taxes as an S Corp.
Correct. Correct. So if you formed your business as an LLC, you're still formed as an LLC from a legal perspective, but you're being taxed as an S Corp. Correct. Correct.
Correct. Okay. So now let's take that one step further. So a business becomes an S Corp and I think some people also get this distinction confused. It's not necessarily what you're doing in top line revenue. It's what you're doing in net income. So it's possible that you could be doing 500,000 in top line revenue, but if your net income is $50,000, they may not, well, we would want to look at your business and why your net income's only $50,000, but they're maybe not recommend you be an S-Corp at this point because you don't have enough to pay yourself.
You don't. And that's the thing that we don't want you to become an S Corp too soon, because then you can't pay yourself a reasonable compensation and then you can't take draws. And that's really the benefit of becoming an S Corp. Once you pay yourself a reasonable compensation, you can take as much in draws as you want. You can also do an accountable plan. So when we work with our clients, our tax clients, every single one of them receive a reasonable compensation report. And we use a third-party vendor that has stood up to IRS audits. So we know that we're audit protected with this piece of paper. And once we've paid ourselves enough that matches this piece of paper, you can go and take as much cash as you want from your business. You can also use what's called an accountable plan. An accountable plan allows you to actually reimburse your business money for the use of your home office, your personal vehicle, some anything that's dual business and personal. And the difference is, as an LLC, that's just a tax write-off. It's an area of your tax return. You don't cash, like you don't get the money as an LLC for your home office. Kickstart actually pays me rent. So this room is used for everything, and Kickstart pays me rent through my accountable plan, where I receive cash each month. And that is a business expense to the business. So I'm, by paying myself, by you paying yourself, by as an S Corp, when you pay yourself through payroll and through an accountable plan, you're reducing your net income, therefore reducing the amount of self-employment tax that you pay.
Tax. Yeah, great explanation. Okay, so let's get into reasonable comp, because this is we probably get this question every single month about reasonable comp in our groups to you. So you just explained a reasonable compensation would be Christa Gurka or Danielle Hayden, as owner of our business, should pay ourselves a salary equitable to what's deemed reasonable compensation in your area. What happens is, I think people say, how do I figure that out? Right. So can you dive specifically for like boutique fitness businesses where they may be the Pilates instructor, the marketing specialist, the customer service person, like all the hats. Can you go into that a little bit?
Yeah. So I love in your group when somebody will say to me, well, I pay myself for each of the sessions that I have or the classes that I teach. And I'm like, the IRS doesn't care. They literally don't care. The IRS doesn't care how many clients I serve. They don't care. They don't care how many classes you teach. The IRS says if you needed to pay somebody to do your job, and that job is to run the business, you are running the business. How much would you have to pay somebody to do that job? You could go to salary.com and say, how much would you pay somebody in this area to do this position? But it's not just a practitioner. You're not just a practitioner, you're a practitioner plus. So it really needs to be the CEO. So what our software does is it takes into consideration your location, the size of your business, the number of employees. It even asks questions like, are you below or above average in your performance as a business? So I'm very profitable. Where is my performance? We can go very detailed in the amount of time we spend in each duty, but we actually try not to do that because it changes. And it really doesn't matter. It changes every month, every day, every month. You're just doing whatever needs to be done. So I encourage you to not go down that rabbit hole of exactly what you're doing, but just knowing that you are running the business in that area and the size of your business, and then above or below average performance.
Great. So let's say, I think we did this exercise for mine, and let's say the average salary for someone, an operations director, probably in Miami area, is like $100,000. So what you're saying is that as an S Corp, Christa Gurka, Pilates and the Grove should pay Christa Gurka $100,000 roughly prior to me taking a distribution from my company.
Correct.
Great. Now, what I think people hear is I have to pay myself $100,000 and my business doesn't have $100,000, but that's actually incorrect on their part. So can you go like they just can't take draws until they get to that point, correct?
Exactly. If your business doesn't have $100,000, the IRS is not looking for you to take a loss and hurt your business. Here's the problem though. Okay. It's quarter one and I need that cash, right? Like I told you before, it's the client, the business owner who's like, at $5,000, I want all the cash. I don't want to pay payroll taxes. And then you take the cash as a draw. You haven't paid yourself the reasonable compensation. And then it's all of a sudden July and you still don't have the cash and you're taking draws instead of reasonable compensation. Or scenario two is I'm paying myself, but I'm only going to pay myself like $50,000 because I'm not really sure if I have enough money yet. So I'm going to pay myself 50. Then that damn IRS tax bill comes out. And the tax bill you want to pay from your business account because it's the business's taxes. I get it. It's not though. The IRS says that it's your taxes. It's you. It's a flow through. You personally are supposed to be paying those taxes. To be clear, my business pays the taxes, but that's okay because I'm paying myself a reasonable compensation. When you make that tax payment, if you have not paid yourself a reasonable compensation, you have now just taken draws. So you have to be able to pay yourself that reasonable compensation or the personal expenses, the tax payments, and the owner's draws have to 100% stop.
Yeah, totally agreed. So this just question popped in my head. It's not one that has come from the group, but I just thought of it. So say you get to a reasonable comp, what's deemed reasonable comp, is in your opinion, everything after that is a draw. So what if your draws are more than your reasonable comp? Does that ever happen?
It can. So here's the difference. There are some tax influencers and CPA gurus out there that have gained traction over the years. And so there's these calculations on the interwebs about 1/3, 1/3, 1/3. That if you're paying yourself 2/3 through payroll and 1/3 through owner's draws, should be okay. Should be okay. It really depends on the mood of your IRS agent. Okay.
Right.
So we don't want to use things that the IRS has not given us. That is not a true IRS guideline. So you really want to have a reasonable compensation report that then like I would not exceed my owner's draws above my payroll amount unless I have this RC report, this reasonable compensation report. And once you have that, then that's fine, right? Like your business is doing great. Take all the cash that you want. I hope that some of it's going through an accountable plan, so it's reducing your taxes. And you should probably be talking to your tax accountant about that situation. But yeah, you absolutely can.
Okay. Yeah. Once you surpass that reasonable compensation.
Yes.
Great. Yes. Great. Okay. So let's move into saving for taxes. So like you just mentioned, when we're an S-Corp, it's a flow through to our personal taxes. So for example, Pilates in the Grove does $1 million in revenue. They pay Christa Gurka $100,000 in salary. I take my taxes out of there, et cetera, et cetera. But I then still have $200,000 in profit and net income. I, Christa Gurka, am paying taxes on the $200,000 profit, correct? I got you in the middle drink. Sorry. Yes.
No worries.
Okay.
Yes, that is absolutely correct.
Right. I think some people forget. They're like, oh, I'm on salary. I'm paying taxes on my salary. So I don't have to save anymore. Right. But you're paying we get to pay taxes on the profit, whether we take it or not. Okay.
Correct.
So your recommendation, and I know that this is different for everyone. Everyone's in a different tax bracket. All the states are different. Do you have a recommendation you give to your clients that they should be saving? Like, do
Yep.
you do 30%, 25%? I mean, do you base it on each individual?
So when our clients receive their financial statements each month, every single one of our clients receives what we call the snapshot. And in the snapshot, we take the net income and
Mhm.
multiply that by 25%. We do
Okay.
use 25% across the board. And we used to get really detailed about it and say, okay, what was last year's tax rate? Let's apply last year's tax rate to it. But things change. Like
Mhm.
your tax rate might have been low or high last year, but things change. And so I want you to have enough saved. I'm not telling you to give the IRS that money. When you
Right.
are paying the estimated taxes, your CPA will give you the coupon book. Your CPA, when they file your taxes, should be giving you the amount of estimated tax payments that are required. That is the amount that you should be paying to the IRS, is the amount from your previous year's return. Here's what happens though. As for our clients who are doing really well, you're paying estimated taxes based on last year's profit. Awesome. But as this year goes up, we need to have more in a savings account so that when the taxes come due, you're not caught off guard.
Right. And that, unfortunately, I'm sure you've seen it. I've
Happens
seen
all the
it. It
time.
happened to me one year, actually, and I got caught off guard and just got upside down a little bit. And so,
Yeah.
learning moving forward, I do save every month. And, the worst that's going to happen is I'm going to be over, and then I get to reinvest that money and do as I wish. So, let's talk. Go ahead. What were you going to say?
I was just say that's why we're not giving it to the IRS. We can put it in a high yield savings account on our own
Mhm.
and make money on it. We don't need to give it to the IRS and give them an interest free loan.
Yeah. So that's actually was going to be my next question. This has come
Okay.
up a lot. High yield savings accounts. So, I mean, most of us know that keeping it in the bank does not earn us anything. It's like my grandparents who lived through the Depression used to stick cash in their shoes and under their mattress, but that's because of their experience, and cash on hand is for them was something they wanted to have, like literal cash in shoe boxes. But as a business, we can choose to keep our tax savings or an operational savings in a high yield savings account. So, can you explain what a high yield savings account is? If you know the current rates of that by any chance, and like how we would just transfer that money from our business bank, because it still has to be in our business name, correct?
Correct.
Okay.
This is a big thing. This is a big problem, the business name, because there's not as many banks who are allowing it for businesses. And so people were going and opening them in their personal account. If you open it in your personal account, it's an owner's draw.
It's a distribution, right?
So it
Right.
has to be in the business name, and then yes, the money can sit in that high yield savings account.
Yeah. So I actually just went, she's actually going to be a episode on the finance month. She's my money manager. I like to call her my wealth manager. And she actually would recommend she opened a brokerage account under my business name. And so we transferred money from my right into a high yield savings account. It's liquid. I can take it out whenever I want. And she also said, if you don't need it to be liquid at some point, you can do some small things with it. But what are the high yield accounts that you have recommended for people in our group? Some places that they can go put their money in.
So part of the problem is they keep on changing. Depending on when this airs and then when you're trying to go look for it, I personally use Flourish. American Express is one. Mercury is one. It depends on who's running the campaign for high yield savings accounts at that time. But I would recommend talking to whoever is your financial advisor. So we use Flourish because our financial advisor has set us up with an account there.
Mhm. Yeah. Do you know what we were just talking about this in the group yesterday, and I couldn't remember what the current interest rates on high yield accounts are. Do you know what they are? I think they're just above
They're about,
4.
yeah, between 4 and 5.
Yeah. So I think mine when I opened was 4.8. I think it's down a little bit. I think now they're at maybe 4.1, 4.2, but it's way better than what you're getting in the bank.
Yeah.
just sitting
And,
there.
and any really money market account, it's probably
Yeah.
better than, because that was the equivalent
Yes. Yeah.
previously.
My money market account is like 1% or something like that. I don't know. It's like very low. So yeah. Okay. So another question we get from people is the profit first method. I'm going to do like, like a little bit of profit first, right? But the having different bank accounts. And I know you and I kind of see eye to eye on like, we don't have to have five. It doesn't have to be the complete percentages. Can you give an example? Well, not an example necessarily, but explain to people why having different bank accounts is a good thing, and kind of maybe an overarching principle of operational account, and then which other accounts one might have as a business owner.
Yeah. So, love you, Mike McAllowitz, but I think the profit
Mm-hmm.
first method is very broken, and it is very difficult for business owners to have those types of percentages laid out and then not be able to reach them. And it causes an administrative nightmare, like
Mm-hmm.
absolute nightmare. Um, I recommend three accounts. One is your operating account. All the money comes in, all the money goes out, paying your bills, your payroll, like that is the flow through account. The only time that you make transfers is to your tax savings account, where you're saving that tax reserve we were just talking about. And then you'll also have an operating account where you're saving between 1 to 3 months worth of operating expenses. So we're moving that money over. And then really, once you have enough saved for taxes and you have enough saved for your 3 months worth of rainy day funds, you're not transferring money back and forth all over the place, causing yourself, a minor heart attack when you don't have enough cash for payroll now because you moved it over to the
Right.
profit account. So it's just three simple accounts. One's a checking account, and the other two are savings accounts. So two savings account, one checking account.
Yeah, that's exactly what I have in my savings account or money market accounts. Once my tax savings and my operational account I just didn't need to have any more savings account. That's when I started moving the overflow into a high yield account, and it sits there and makes money. But at the end of every month, I get my net income statement. I save 30%. I err on the side of caution for my taxes. I'm in a high tax bracket where I am. So I save 30% goes into my tax savings account. And then I have my percentage that I take as a distribution. And then I put the rest in an operational savings account. So same thing. And then my
Yep.
operating account should stay in the same, there should always be like 1 month of operating expenses in there because I get all the revenue in that month. I pay all my expenses, and then we take a little bit out of it. So, and what that does for us too is it just helps cash flow perspectives, right? And you can start little by little having cash on hand, because most people think revenue and profitability is the reason businesses go under. But to my knowledge, it's people just
It's
don't
cash.
have cash. They just don't have cash.
So here's what happens is I can't tell you how often clients will say, you keep telling me that I have profit, but where's all my cash? Like, where'd all the
Mm-hmm.
money go? It's my team's like favorite question to answer. So, like, yeah. So should you ask the balance sheet and the cash flow statement? Is where all your cash is hiding. Because what happens is we're not looking at all three statements. We're looking at the profit loss statement. We understand our profit. And it's the easiest of the statements, and it's the most famous. You get to the balance sheet, and if you've taken on debt, or if you have credit cards, if you're taking owner's draws, personal expenses, large tax bills, if you're purchasing any type of inventory, equipment, maybe leasehold improvements, you're building out a second location, like all that cash is sitting on your balance sheet. And when you pay down your debt, or you make that big tax payment, or you have a bunch of leasehold improvements, it's not showing on the P&L. It is showing on the balance sheet. And I understand I'm getting very accounting-y right now, and people are like, oh, starting to break out in
No, but
hives.
it's important for them to understand that, because I get a lot of people that they're like, oh, look, my net income is, I'm at 30%. And I'm like, okay, how much money do you have in the bank? And they're like, well, nothing. I don't understand. This is exactly what you're telling them. It's important for them to know that.
It is important. It is important. And I want everyone to know that I'm poking fun, but I do get it. It's not easy, right? Understanding all those reports aren't easy. But if you're having that cash flow problem, if you're feeling that, like when I said that, you're like, oh, that's me. Make sure that you are talking to your money team, talk to your bookkeeper about what is on the balance sheet and what's on the cash flow statement, because it's going to help you tie everything together.
Right. And ask the questions. The balance sheet took me a little while to learn to understand what that was telling me, because you have your assets and your liabilities. So it's like what you owe and what you own. And then the cash flow statement came last. That was even more confusing to me initially.
It is.
Yeah, but I do understand it now. And so I think everyone can learn how to do this and at least learn enough to ask the right questions to the experts on your team, right? To your bookkeeper, to your accountant, so they can technically show you the money, like literally show me the money. Where is it and where did it go?
So you don't need to know, nobody should ever need to know how to be a bookkeeper.
Mm-hmm.
I went to school for a really, really long time. And my team has gone to school for a very long time so that they know where to classify every transaction, how to make sure that everything is accurate for you. And you don't need to know how to do that. But where you do need to take responsibility as a business owner is how to ask questions, how to look at the information. We're sending out financials for all our clients for January. And every month we provide some reflection or coaching questions to help just kind of spur the thoughts. And, you know, the goal of that is to remind business owners that I can work my tail off and making sure everything's organized and in the right place. And you have all the information. It's really pretty and it has colors and some charts. But if you don't open the email,
Mm-hmm.
if you don't read the information, if you don't respond with questions, if you are not engaging, like nobody else can take that
Yeah.
responsibility. And I would argue the minute you decided to start taking money from clients and you started going into a relationship with vendors and your landlord, you have a responsibility. So I really don't care if it feels uncomfortable. I don't care. The IRS doesn't care if you're not a numbers person or if it doesn't feel good. You have a responsibility to your clients and to your vendors to look at that information and to understand it and ask questions.
Absolutely. And to your team and to yourself, so you can make sure that you can keep meeting
Yeah, most
payroll.
importantly, to yourself.
Yeah.
To you.
Yeah. So I have two final questions for you. One, we did, you just kind of broached over like deductions too, a little bit. So let's talk let's talk a little bit about deductions. And specifically, Christa, brought Danielle on my team as my CFO, and I want to give her a computer, or I want to gift her some piece of software. Can you talk about how one is a gift and is not allowable, and the other one is a work expense? So can you talk about like the difference and how you can make that happen?
The IRS needs to update their darn gift policies. The problem is they want their money. So if
Yeah.
you're going to gift anything, they really want it to go through payroll. So you can buy like a sweatshirt, t-shirt, and the max is really $25. Luckily, the IRS lets us embroider it and ship it for costs outside of that. However, if I fallen in love with this Remarkable. Have I told you about this?
Oh, yes.
Freaking love it. Okay. So I really want to give a team member a Remarkable. Well, it's really technically I can't send them this gift. But what I can send them is if I load this with Kickstart content and Kickstart branding, it now has become a piece of equipment. And I can give
Mhm.
guidelines of how much business versus personal use I want on my piece of equipment. Uniforms in this industry are huge. This is a huge issue. If you are not actually buying a uniform embroidered with your logo, it's not actually a uniform. But people will go buy clothes and code it as uniforms, air quote coded as uniforms in their software. Unless that is technically actually a uniform that is embroidered with your business name, It's not a uniform. So you can get away with this by buying you and your team jackets and sweatshirts. And I said I wanted to
Mhm.
buy everybody a whole winter getup because I really wanted a new hat and gloves and stuff. So it was going to all be embroidered in Kickstart. Um, that is another way of making something that's really not tax deductible. Tax deductible.
Yeah, that's great. Great little advice. Okay, and finally, and this is like my favorite question. Let's talk a little bit about healthy percentages. And let's just kind of go down the list. We're actually going to link in the show notes a PDF of what Danielle provided our members with a healthy percentage worksheet. So what healthy percentages basically is there's definitely a little wiggle room in there, but like what you should be spending in relation to your revenue, right? So let's start with, most of my listeners are brick and mortar. So let's start with facility percentages. So in terms of a healthy percentage for a business, how much should we be spending on rent?
So we want to be between 8 and 10%. Now, I like to give the caveat with this whole worksheet.
Mm-hmm.
You can be under in some areas and over in some areas. This isn't perfect, but you can't be over in all the areas. Okay.
Right.
So
Yeah.
if your facility cost right now is 12% because you leased a larger space so that you can grow into it, cool. We understand that. However, the amount that you can take on in operating expenses and payroll and advertising and marketing are going to be lower. So the big categories here are the facility, advertising and marketing, and payroll. Those are our big ones. So you can't be high in all three.
Yeah. So I think what's important about this is also thinking about that when you're going to look at a space. Now, obviously, when we first start out, we're all going to be high on stuff because 10% of zero is zero, unfortunately.
Right.
But if you are thinking like, oh, my rent is $10,000 a month, that's $120,000 a year. If I'm going to get to a place that this becomes a healthy percentage, that means that you need to do $1.2 million a year in revenue to kind of fall into that category. Now that's just, I get it. There's no nuance to that. That's just like black and white. But I think it's important for people to learn, like that's a lot of Pilates you have to sell to hit $1.2 million in revenue. So it's just something to think about. Okay. So let's go. The next biggest item, usually for people in this industry, is payroll costs. So let's talk about payroll costs.
So I want you around no more than 30% for payroll costs. And again, where is your facility?
Mm-hmm.
If our facility is lower or we're in a more established season of our business, this might be higher, closer to 50%, but our payroll can't be high if we're also in high growth mode. So if we're trying to spend a lot of money in advertising and marketing, then we might need to have lower payroll while we ramp up the sales in our business.
Okay, so you're also in a service-based business. You have account managers that help clients, as do we. We have instructors. So the pushback I'm imagining in my head what people are going to say is, well, I need all of these instructors to teach the classes. So how can I be low in payroll as I'm growing? Because it seems like an oxymoron.
It is. There might just be seasons of low profitability,
Okay. Yep.
and as we grow, we're not always more profitable. I am less
Mm-hmm.
profitable today than I was 8 years ago.
Yeah.
Just is. Bigger businesses are not always more profitable. It also depends on your core values. My core values, my priority is to really pour into my people. So we are prioritizing career growth and laying out a long career plan for our team members, training and systems for efficiency. Like we are a people first organization. My goal for 2025 is not profitability. My
Mm-hmm.
goal is to grow. We're investing in marketing, we're investing in people. There might be a season where I decrease that and I change that. I had a client who literally watched her go through every single season that as she started her business, she had very low profits tons of money in advertising and marketing. She was going to every event. She was out in the community. She was doing the thing. As she stabled, as she like was getting the revenue in the door, she had decided that she wanted to buy a home. And so she shifted her priority and made sure that she was paying herself enough, taking those owner's draws, and pulled back on marketing. When her mom got sick, she was able to pay her people so that her people could help her run the business. She had to shift down her payroll, and she wasn't profitable. As she continued to grow and as a business owner, she was able to shift that again after her mom passed away to balance out how much people she needed in her business versus profits. So there's no right answer.
Right.
15% is the guide. So like a very healthy business is between 10 and 15% profit.
Yeah. And I would say a very healthy business is between 10 and 15% profit with paying their owner a reasonable salary. Both of those. That's like a really, really healthy business that is sustainable, right? Because a profitable business at 15% when the owner is making zero is not sustainable.
Not sustainable.
Yeah. And I think Danielle really preaches it's profitable and sustainable. Those need to be hand in hand. So
as long as that's your goal, if you're not in it for the
yeah,
long term, if you're building a business to sell it in the next 5 years, your goals are very different, right? The way that you run your business is very different. I don't think most of the listeners of this podcast are thinking that way. Like we're in it for the long game.
Yeah. I mean, I said this in the call yesterday with the inner circle group. I was like, all of us on this call, our job, our business, our payroll is putting food on our table. Like we need the income, we need the salary. It's putting food on our table. It's putting our kids to school. It's paying our bills. So at least none of the people I mentor are people that either are doing it for a hobby, they have a lot, or they have another initiative. They need their salary. But again, they could have their salary without working 80 hours a week and being burnt out. So the two don't have to coexist together. So this was super, super, super insightful. So thank you always for your answers. Let's tell people your podcast, because I think a lot of the topics we talked about today, you actually have very specific podcast episodes that relate to them. And then where can they find you if they maybe want to even take a discovery call with you or reach out to you about bookkeeping services?
Business by the Books is the podcast. Talk about how to use your numbers to run your business every single week. And like Christa said, there is I can talk for a very long time. So there is a lengthy podcast on each of these topics. If you're like, oh, I want more on the S-Corp thing, there's a podcast episode for it. And then kickstartaccountinginc.com is the best place to connect. If you actually go to kickstartaccountinginc.com/gift, you can download the top 10 deduction worksheet. So go to the gift website. It's a really amazing handout that my team works really hard on.
Awesome. We'll link that in the show notes also. And if you're interested, Danielle does a monthly call with our inner circle group, and she does a quarterly call with our FitBiz community. So if you're interested in being in a community where you get access to ask Danielle, and her team money questions, you can go ahead and visit my website, www.christagurka.com. And until next time, my friends, bye for now.